Welcome to Tech Money Madness, your daily U.S. stock market deep dive into the source material. It's March 24th, 2026.
Glad to be here. And what a day to be looking at the ticker.
Seriously. Welcome, learner, to today's deep dive. Imagine, checking your phone's weather app and seeing a bright yellow sun icon, but then you look out your living room window and it's just pouring rain.
Right.
That is basically exactly what the U.S. stock market is doing today. We're looking at a market that seems to be hallucinating almost, like it's giving us wildly conflicting readings about the physical world.
Yeah, I mean, the disconnect between the financial narrative and physical reality is, well, it's wider right now than it has been in years.
Which is exactly why we're here. Our mission today is to cut through the daily noise of this comprehensive market briefing we have from March 24 and, unpack what is actually driving the capital markets.
Because there is a lot going on beneath the surface.
Exactly. I mean, we are looking at a massive sudden relief rally, a looming multi-billion-dollar tech IPO that could completely change the gravity of the market, and this bizarre, almost dangerous disconnect between how much oil Wall Street thinks we have versus what is actually flowing through the pipelines.
It's a lot of process.
It is. Okay, let's unpack this, starting with the biggest headline dominating the ticker tape today.
The geopolitical relief rally that just got triggered in the Middle East.
Yeah. So just giving you the raw facts from the briefing here, President Trump announced a 5-day pause in military strikes on Iranian energy infrastructure. And the market's reaction to this news was, it was absolutely instantaneous.
Oh, yeah.
The S&P 500 rose 1.37%, the Dow gained 1.72%. But the real star of the show was the Russell 2000.
Small caps.
Right, the index tracking small cap companies. It outperformed everybody with this massive 2.58% gain. Meanwhile, global oil prices just crashed, nearly 8%.
Which is a huge intraday move.
Huge. And that massive drop in oil naturally dragged down the entire energy sector, but it acted like, rocket fuel for consumer discretionary and travel stocks.
Yeah, the cruise lines in particular saw a massive influx of capital today. Like Norwegian Cruise Line, ticker NCLH, shot up 7%.
Wow.
Carnival, ticker CCL, jumped 6%. And Royal Caribbean, RCL, they gained about 4.5%.
I'd have to push back on this market reaction, though, because I'm looking at the actual timeline in the briefing. A 5-day pause.
Right.
Just 5 days. Help me understand that. Does an 8% crash in global oil prices make logical sense for a 5-day Band-Aid? Or is the market just acting completely irrationally here and going on some short-lived sugar rush?
Well, what's fascinating here is the sheer speed of algorithmic trading versus, the reality of physical supply chains.
How do you mean?
Well, the market algorithms aren't doing deep geopolitical analysis in the first milliseconds of a trade. They're basically just scraping the headlines for keywords. They see pause combined with energy infrastructure, and they instantly short oil futures.
So they sell first and ask questions later.
Exactly. But to understand the stock market's reaction, specifically those equities you mentioned, you really have to look at the mechanics of operating expenses.
Like the Russell 2000 jumping 2.58%. Why did they spike so much higher than the massive tech giants in the S&P 500?
Because small cap companies are they're highly sensitive to domestic economic conditions and their immediate input costs.
Right.
When you're a mid-sized domestic logistics company or like a regional manufacturer, fuel is a massive line item on your monthly budget. So an 8% drop in energy costs hits your bottom line instantly.
Okay, that makes sense.
Right, a major international conglomerate might not care about a 5-day dip, but a small cap company sees instant tangible relief in their operating margins.
Wait, but I always assumed companies just locked in their fuel prices ahead of time. Why wouldn't a smaller logistics company just hedge their fuel costs like the big airlines or mega corporations do?
Because building a multi-year financial hedge requires a massive treasury department. You need complex derivative contracts, a huge amount of tied-up capital. Small caps simply don't have those resources.
Ah, so they're exposed.
Yeah, they buy much closer to the spot price. So when the spot price crashes 8%, their profit margins expand that very same afternoon. And we see that identical logic scaled up with the cruise lines.
Because of the bunker fuel.
Exactly. A modern cruise ship is essentially a floating city that burns massive amounts of fuel. It's one of their single largest unavoidable operating expenses. So the market is buying those stocks today because it's pricing in the immediate mathematical relief to their profit margins.
But algorithms trading purely on headlines creates a massive blind spot, right? Which kind of brings us back to that weather app analogy. The stock ticker is flashing green, telling us the energy crisis is paused.
Yeah.
But someone who actually deals with the physical reality of energy is looking out the window and warning us about a storm.
Yeah, Mike Wirth, the CEO of Chevron, offered a very sobering reality check in today's briefing.
He did. He came out and explicitly warned that the physical supply of oil is much, much tighter than the futures market suggests.
Right.
He's basically arguing that the true impact of the Iran war is not fully priced into the oil market.
And this highlights the critical difference between, paper oil and physical oil.
Paper oil being the futures contracts.
Exactly. The contracts that traders are just swapping back and forth on their computer screens. Physical oil is the actual, tangible liquid sitting in supertankers, refineries, and pipelines.
The real stuff.
Right. And Wirth is looking at the actual barrels available globally and realizing the math simply doesn't add up. A 5-day pause in military strikes might calm the algorithms down, but it doesn't magically teleport millions of new barrels of crude oil to refineries.
So the physical supply chain is still highly degraded. See, I'm looking at these macroeconomic indicators, and I'm honestly lost on how to reconcile them. If the physical oil supply is dangerously tight, which historically drives up costs for shipping, manufacturing, consumer goods, why are we seeing a major global economy like Japan flashing massive warning signs of an economic slowdown?
That's a great question.
The briefing notes their core inflation for February just missed estimates, falling to 1.3%. That is the lowest level since March 2022. That feels like a total contradiction. Are we seeing conflicting signals about global demand?
We are seeing two massive forces colliding. Instead of a simple tug-of-war, think of the global economy right now like a set of hydraulic brakes on a speeding car.
Okay.
On one side, the Middle East supply shocks are slamming a brick on the gas pedal, threatening to push energy prices higher.
Okay.
But on the other side, sluggish economic demand in Asia is simultaneously pulling the emergency brake.
So, mechanically speaking, how does Japan's missing inflation act as an emergency brake on oil prices?
Well, when Japan's core inflation falls to 1.3%, it signals a freeze in domestic consumption. Yeah. Japanese consumers just aren't buying as many goods.
Right.
And when consumers stop buying, Japanese auto parts manufacturers and electronics factories receive fewer orders. So they run their assembly lines for fewer hours.
And less factory time means less power.
Exactly. When factories run fewer hours, they literally burn less imported liquefied natural gas and oil. Multiply that industrial slowdown across the entire Asian region, and you have a massive physical reduction in the number of oil barrels the world needs today.
Wow.
That deflationary signal acts as a counterweight to the inflationary supply shock in the Middle East.
That makes the market's jittery behavior make a lot more sense. The financial system is caught between severe geopolitical supply constraints and fading global demand. But while the global economy rides those hydraulic brakes, individual companies cannot afford to just stand still. They are being forced to place their own bets. And today's briefing highlights some massive billion-dollar capital allocations that show completely divergent strategies for navigating this specific volatility.
Yeah, the contrast between how Toyota and Eli Lilly are deploying their capital today is basically a masterclass in corporate survival strategies.
Let's look at Toyota first. They just announced a $1 billion investment in 2 U.S. manufacturing plants. And the briefing notes this is just a down payment on a much larger plan to invest up to $10 billion domestically over the next 5 years.
Right.
Then you look at the pharmaceutical giant Eli Lilly. They're taking the exact opposite geographical route, announcing a $3 billion investment in China over the next decade.
If we connect this to the bigger picture, you're seeing two distinct philosophies on how to build a corporate fortress for the 2020s. Well, Toyota is executing a strategy known as onshoring, or friendshoring. They're looking at the exact geopolitical chaos we just discussed, the vulnerable shipping lanes, the energy volatility, and deciding that the only way to guarantee they can build cars is to bring their supply chains physically closer to their primary consumer base in the United States.
So that $10 billion isn't just for factory equipment.
No, they are buying immunity from international shipping chaos.
Building a literal physical fortress.
But I really have to question Eli Lilly's strategy here. Why on earth is a massive U.S. pharmaceutical company pouring $3 billion into China right now amid all these global geopolitical tension?
It seems counterintuitive.
It does, especially, and this is a massive detail from the briefing, when the U.S. Supreme Court just allowed a multi-billion-dollar class action lawsuit to proceed against them here at home.
Right.
That feels incredibly reckless. You have a massive legal headache threatening your domestic business, and your solution is to throw billions into a highly complex, tense geopolitical landscape in China. It looks reckless until you look at the demographic math. A multi-billion-dollar class action lawsuit functions like a giant anchor on a company's balance sheet.
Yeah, no kidding.
It threatens to severely compress their domestic profit margins for years to come. So when a board of directors sees that kind of domestic threat, they are forced to seek out aggressive, high-volume growth elsewhere to offset the damage.
So they basically have to outrun the lawsuit by finding new revenue.
Yes, and China has a rapidly aging population that represents one of the largest untapped healthcare markets in human history. Eli Lilly is calculating that the massive, long-term revenue potential of selling medications to millions of aging Chinese citizens outweighs the short-term geopolitical friction between Washington and Beijing.
That is a wild bet.
Toyota is spending money to hedge against chaos. Eli Lilly is spending money to outgrow their domestic liabilities.
So Eli Lilly is spending $3 billion to buy access to China's demographics. But speaking of massive capital allocation, the technology sector is spending exponentially more, not to buy access to people, but to build entirely new digital brains.
Oh, absolutely.
The tech sector is suddenly splitting into clear winners and losers based on one specific thing: infrastructure.
The AI infrastructure boom. It is completely reshaping how capital flows through the U.S. equities market.
The briefing explicitly lists Microsoft, Apple, Amazon, Google, and Meta. They are all pouring billions into this space. And Wedbush Securities analyst Dan Ives has officially planted a flag, identifying 2026 as the critical inflection point for AI.
Which is a bold call.
It really reminds me of the shift from the Wild West gold rush to the railroad tycoon era. A few years ago, AI was all outlaws and prospectors, just pure software hype. But now, it's all about who can lay down the most steel track.
Who owns the physical data centers?
Exactly. Who secures the nuclear power grids? Who owns the cooling systems?
That analogy is incredibly accurate. The consumer hype phase has ended.
Yeah.
The grueling capital expenditure phase has begun. And laying that digital track is, frankly, the most expensive undertaking in modern corporate history.
But I'm looking at these charts and I'm honestly lost. If Dan Ives says 2026 is the golden inflection point, the moment the trains finally start running and making money, why is Microsoft currently in a market slump? I mean, Microsoft is arguably the biggest player laying down the most track in the entire AI space. Is Wall Street punishing them for spending too much money before the trains are fully operational?
Well, Wall Street is notoriously impatient. What Microsoft is experiencing right now is something tech analysts call the valley of death in capital expenditure cycles.
The valley of death. How does that work mechanically?
Think about the difference between money going out and money coming in. Microsoft is currently spending tens of billions of dollars on physical hardware buying, massive clusters of NVIDIA GPUs that cost tens of thousands of dollars each, building data centers, signing massive energy contracts.
Just a massive cash burn.
Exactly. That cash leaves the balance sheet immediately. But the revenue to pay for it, that comes in the form of, $30 a month enterprise AI subscriptions.
Ugh. It takes a massive amount of time for those monthly software subscriptions to offset the billions spent on the physical hardware.
Right. Investors see the massive expenses hitting the quarterly earnings reports today. But the widespread enterprise adoption required to make that infrastructure profitable takes years to scale. The math hasn't crossed over yet.
Which is why the stock is slumping.
Exactly. Which is exactly why the analysts in today's briefing are explicitly warning investors that it is a fundamental mistake to give up on Microsoft now. You do not sell your shares in the railroad company right before the final spike is driven in.
And you can see that tension reflected in the day's most active stocks: Apple, Amazon, Tesla, NVIDIA, Microsoft. The liquidity is swirling around the companies that are actively building the physical infrastructure of the future.
Yeah.
But speaking of liquidity, there's another monumental event shaping the 2026 tech landscape that I want your take on. The briefing mentions that SpaceX is expected to officially IPO its stock this year, which is poised to make Elon Musk even richer. Beyond the personal wealth aspect, what does a SpaceX IPO actually do to the broader market?
A SpaceX IPO isn't just another tech company going public. It creates a massive gravity well of capital.
A gravity well. Explain that.
Well, for the last decade, institutional money has largely flowed into safe index funds or high-margin software-as-a-service companies. Building an app is relatively cheap. Building reusable orbital rockets is incredibly expensive and dangerous.
Yeah, very different risk profile.
When a giant, private, hard-tech company like SpaceX goes public and proves it can be wildly profitable, it completely validates the physical engineering thesis. It forces massive institutional investors to pull billions of dollars away from software startups and reallocate it toward real, physical steel, advanced manufacturing, and rocket fuel.
So it shifts the whole paradigm.
It proves that the market is willing to fund massive physical engineering projects again, reinforcing tech's absolute dominance over the broader U.S. economic growth story.
Okay, here's where it gets really interesting. If the tech sector requires all this massive physical infrastructure, data centers, orbital rockets, electric vehicle gigafactories, what are they actually building it with?
The raw materials.
Yes, this brings us to the raw materials, the industrial underdogs, and the specific places where analysts are actually spotting buying opportunities amidst the market losers.
This is the hidden physical layer of the entire tech boom.
The classic investment advice is, during a gold rush, don't buy the gold miners, sell the shovels. So I am looking at MP Materials in the briefing. They are a domestic rare earth mining and magnet manufacturer. Analysts are highlighting them today as a prime buying opportunity, but only because their stock has dropped a staggering 47% from its October peaks.
Yeah, it took a huge hit.
And for context, other related sectors took hits today, too. ENPH was down about 5.5%, MUSA down 4.7%. Help me square this circle. If AI and advanced tech require so much physical hardware, and rare earth magnets are literally the shovels of this infrastructure boom, why did a domestic shovel seller plunge 47% in the first place? Why is the hardware sector bleeding if the infrastructure boom is in full swing?
To understand that 47% drop, we really have to look at the massive debt required to pull these materials out of the ground. Mining rare earths isn't just about digging dirt. It requires incredibly complex, massive chemical processing facilities.
Right.
And building those facilities requires borrowing hundreds of millions of dollars.
And when interest rates are high, the cost of borrowing that money skyrockets, which crushes their profit margins compared to, say, a software company that just needs laptops and coders.
Yes, they are incredibly vulnerable to high borrowing costs. Furthermore, the global spot price for rare earth minerals is heavily manipulated by international, state-subsidized competitors who can intentionally flood the market to drive prices down and bankrupt newer domestic operations.
Wow, a double whammy.
MP Materials got squeezed by a combination of high debt costs and volatile global commodity pricing.
So their stock gets punished for short-term margin compression. But why are analysts suddenly calling it a buy?
This brings all our themes together perfectly. Remember Toyota's $10 billion onshoring strategy, the push for secure domestic supply chains.
Building the fortress.
Exactly. MP Materials is a crucial load-bearing pillar of that fortress. They provide the highly specialized rare earth magnets needed for electric vehicle motors, wind turbines, and crucially, the massive cooling systems inside those new AI data centers.
Okay, I see where this is going.
The analyst looking at Dan Ives' 2026 AI inflection point realized a fundamental truth. The U.S. tech sector absolutely cannot rely on vulnerable international supply chains for these critical components forever.
Because if a geopolitical event shuts down the shipping lanes, the entire multi-trillion-dollar AI boom just grinds to a halt without those magnets.
Precisely why market volatility creates these massive price dislocations. The algorithmic traders punish MP Materials stock for a bad quarterly earnings report driven by interest rates. But the deep value analysts look at the underlying strategic asset, a domestic monopoly on critical AI hardware components, and recognize it as an essential undervalued piece of the 2026 infrastructure puzzle.
It is a profound disconnect. The algorithms see the short-term debt, but the analysts see the long-term strategic necessity. Just like the futures market sees a 5-day military pause, while Chevron's CEO sees the physical supertankers sitting empty.
The market is currently operating on two completely different timelines simultaneously.
So let's pull all these thematic threads together for you, learner. We're looking at a market that is trying to balance on a razor's edge between narrative and reality. On one hand, you have immediate, headline-driven reactions. A 5-day pause in Middle East military strikes sends the trading algorithms into a frenzy, sparking a relief rally that boosts small-cap stocks and sends cruise lines soaring while oil crashes 8%.
The short-term algorithmic sugar rush.
Right. But operating entirely beneath that surface noise, you have massive, decade-long corporate realignments based on physical reality. Toyota is pouring billions into the United States to build an industrial fortress against supply chain chaos. Eli Lilly is betting billions on China's aging demographics to outrun a massive domestic legal anchor.
Yeah.
And big tech is pushing through the valley of death, laying down immensely expensive physical track from NVIDIA GPUs to SpaceX rockets, waiting for that 2026 inflection point to finally pay off.
And every single one of those long-term bets relies on the physical energy and materials markets holding steady.
Which leaves us with a critical, provocative question to chew on as we wrap up today's deep dive into the sources. Think back to Mike Wirth, the CEO of Chevron, looking past the ticker tape and warning us about the physical shortage of oil barrels.
Right?
If he is right, and the physical energy market is quietly much, much tighter than today's 8% price crash implies, what happens on day 6? What happens when that temporary 5-day military pause ends?
This really raises an important question about the fragility of this entire technological transition.
Exactly. How vulnerable is this massive, energy-hungry AI infrastructure boom, these data centers, these gigafactories, these supply chains, if global oil prices suddenly snap back to physical reality and the cheap energy narrative shatters? It is the ultimate collision between software dreams and hard physical constraints.
It's going to be a bumpy ride.
It's something you definitely need to keep a close eye on as this year unfolds. Thank you for joining us on this deep dive into today's sources. As always, keep questioning the narrative. Make sure you look out the window instead of just checking the app, and stay curious. We'll catch you next time.